Today, we will talk about excess capacity. Excess capacity happens when a business can supply more of a product than the market demands. This can occur in manufacturing, like when a factory has idle workers, or in the service industry, such as an empty restaurant with unproductive staff. Several factors can lead to excess capacity, including overinvestment, technological improvements, mispredicting the market, or allocating resources inefficiently. A company's management needs to stay aware of supply and demand to avoid excess capacity. Having too much excess capacity can harm an economy, as companies may lose money due to high fixed costs and unprofitable sales. However, it can also benefit consumers through special discounted prices. Companies may also maintain excess capacity as a competitive strategy. In China, persistent excess capacity has been observed in its manufacturing industries, particularly in steel, cement, aluminum, flat glass, and automobiles. The severity and duration of this issue suggest fundamental problems in the Chinese economy. China is still facing the challenge of dealing with excessive capacity in its manufacturing sectors despite the government's efforts. This problem has significant implications for international trade and the global marketplace. China's automobile market has been heavily affected by excess capacity, impacting factories that rely on economic incentives and leading to price wars and lower profits in the domestic market. This also has implications for international trade with other countries. The removal of excess capacity from the Chinese market faces challenges due to incentives to keep factories open, and it's unlikely that this trend will change in the near future. The COVID-19 pandemic further impacted China's economy, particularly the auto industry, leading to production shortfalls and global effects. The long-term economic implications and recovery from this setback are still uncertain. Here are 3 key takeaways. 1. Excess capacity exists when the market demand for a product is less than the volume of product that a company could potentially supply. 2. The term excess capacity pertains mainly to manufacturing, but it's also used in the services sector. 3. Excess capacity can indicate healthy growth, but too much excess capacity can hurt an economy. Hope this would help. Thanks for watching.